Okay, well, with affordability going down in the marketplace, more Canadians than ever are looking for opportunities to still buy and own real estate and stay close to their friends and family. This has led to a huge increase in multi-generational households. Not only are current Canadians taking up this, but a lot of the newcomers to our country are looking for different ways to buy into the real estate market, and they're leaning into multi-generational families. Multi-generational households have increased by over 21% since 2011 to 2021. This represents a massive increase, and at the time of this actual data, which is 2021, a while ago, this was representing over 3% of the entire population. Now that number apparently has still been increasing without a real good study to understand where the numbers are, but with the way that things are going on right now, I wouldn't be surprised to see that number hit 5% in the next 2 years alone. In fact, over 500,000 young children under the ages of 14 live with their grandparents. That's a massive number and a large increase from the last 20 years. Now, one of the biggest reasons that we are seeing multi-generational households is, no surprise here, money. Whether it's qualification and affordability, the ability to pool their financial resources together to live in a household and reduce the amount of requirements for extra items, and or just genuinely getting family support when it comes to taking care of kids and little ones. Think about it. The cost of daycare is high. In fact, in many cities, it's $1,500 to $2,000 a month for one child alone. And a lot of grandparents want to be close to their children, whether they're working or not working, to both help out financially and just physically be able to be there to support their family members. So with affordability, money, and just families in general trying to find ways to be closer together, it's no surprise that multi-generational families are coming. So you might not really understand specifically the things you need to look out for when you're setting up an agreement with family members. And for the sake of today's conversation, we're going to talk about mortgage qualification, affordability, and more importantly, what you should actually set up in place if you're planning to move together with a family member. Because just because it worked out now doesn't mean it's going to work out for the next 20 years or 30 years. In fact, maybe in 5 years, there's an exit plan in place for a lot of people to get out and move back on their own. So the first thing you need to think about is pooling resources. Now, each and every family member has the ability to pool money, which could go towards down payment, which could actually make it easier for someone who's trying to get up to that 20% down payment number to be able to qualify for a mortgage. Down payment rules don't change if it's a multi-generational house when compared to someone just buying by themselves or with a couple or something of that nature. You still have to have that money come primarily from your own resources, or if you have a second home, it can come from the form of a home equity line of credit, which means it can come from savings, investments, RSPs, TFSAs, FHSAs, everything. Another consideration is that if there are 2 first-time buyers and 2 that are second-time buyers, the 2 first-time buyers still qualify for all of the same first-time home buyer benefits, which we've covered in previous videos, such as RSP exemptions, FHSA accounts, potentially transfer tax exemptions, and so much more. So it is important to note that you would still potentially qualify for those amounts. Now, how much you qualify for is subject to the type of tenancy that you have, whether it's tenancy in common or joint tenancy. More on that a little bit later. Qualification is really key here. Most banks will only allow income from up to 4 applicants and allow a maximum of 5 applicants on a property. There are a few very select lenders that will consider income from a 5th applicant, but it's typically not the case, and most commonly you see 4 applicants on a mortgage and on title of a property itself. So in larger family setups where there are 5 or 6 people, we will sometimes see one individual not actually go on title or on the mortgage itself, either because it doesn't help the mortgage or because in this situation they had to pick the top 4 people who could qualify for the said mortgage on that property. Speaking of which, when you put 4 people on an application, it can actually change the different types of programs you qualify for. For example, one of the big banks out there that we know about, and there are a few more that have the same policy, will only let you have a secured line of credit product in a circumstance where you have 2 people on title and not 4. Another of the large banks will only allow you to have the revolving line of credit, which grows as you pay it down if you have 2 applicants instead of 4. And there's different guidelines across the board. Thankfully, we work with different lenders, so we have the ability to show you which ones might work differently for your situation. Now, another factor about qualification when it comes to the mortgage, you need to be conscious that everyone's income and everyone's debt is considered on the application. So if you have 2 people who are great income earners, but then you have two people who earn no income but have lots of assets. Those two people that have low income but lots of assets may not actually help out your application, and in fact could be a hindrance if they have other debts. So it's important to keep in mind that each applicant is looked at individually and as a group when you put the entire application back together. Now, we mentioned that we had an explanation of some of the things that you should look out for specifically when you're looking to buy that home. And one of the biggest and most number one things that people do not do but they should do, and we see it come back to bite them later, is a co-ownership agreement. And this is a legal agreement that you should get signed with family members that can actually explain and break down things such as ownership on title, what happens in the event of death and divorce, what is to occur in terms of the money if the property needs to be sold or someone needs to refinance, or if there's a bankruptcy or an insolvency, or all these different things. So here's an example of a few things that I've already covered that you should outline if you're somebody who's looking to buy with someone else. And we'll put these on the screen. Number one, what is the ownership interest of said individual? If you've got two parties that are bringing $200,000 to $1 million purchase and the other two are not bringing any money but they're qualifying, is the ownership interest different for the people that are bringing the money, or are they just ensuring that the people who brought the money come back with at least the $200,000 down payment? So you need to define if that interest is 50-50, 25-25-25, or something else in that document. Number two is operating expenses and revenue. Now this might not seem like a big deal, but when it comes to having the property tax bill pay for the hydro or actually taking care of the lawn or any major repairs such as a roof, you need to determine who's taking care of that and what is the cost associated with it, and how are you determining how to find out the cost. It's something as simple as, do all parties agree on where to get the quote and what is a reasonable quote and what isn't? You've got to put that in writing. Number three, property improvement. So if someone wants to do a renovation and there's a cost associated with that, how do all parties feel about that cost, and is everybody contributing to that cost? How are you determining those factors? This is big stuff, folks. Use and access. So in a situation where, let's say, for example, there's four parties buying, one has the upstairs, one has the downstairs, and there's a backyard for use, does that mean that everyone gets to use the backyard freely and the deck? Are there time slots available to be able to use that? If there's a hot tub, are you actually picking and choosing? I know this might not seem like a big deal, but particularly in the situation where it's two families that are buying separately, or even anybody who's just along the lines of trying to determine a fair and reasonable way to use the property, you need to be able to break things down. And most people might say, well, it's my family, it's not a problem. Well, I've seen families break down over these types of things and sell their property because they just couldn't get along at all. We're going to keep going down the list here. So we got furnishings. What do we do about furnishings? Can we use, like an example of the outside yard? Can someone just put lawn furniture wherever they want to? Or if everyone is co-sharing the house, who gets to pick and choose what happens to the furnishings? Miscellaneous considerations like pets. Who's picking up the pet poop? Who's responsible for it? What happens if the dog or the cat pees all over the carpet? What exactly is going to happen from the outcome from there? Are we allowed to have cats or not have cats or dogs? What happens when you sell the property itself? Are there going to be expenses? Yes. So who's going to pay for those? And then who defines who that is? And who picks the realtor or has input on that? Some big considerations right there. Dispute resolution, and then cost of the agreement itself. So you need to make sure that if something goes sideways, you guys have clarity on specifically who is actually going to help you resolve these disputes. I can tell you having it in writing is going to help you right off the bat. And of course, what is the cost of the agreement and who's actually determining that. Now, assuming you've worked with a lawyer and you could work as a family ahead of time to write these things down and go to a lawyer and reduce your costs significantly, the next step is to go to the lawyer and present those costs so that they know exactly what you're signing to and they can get independent legal advice or otherwise. Now, in my experience, the cost of these agreements typically starts at about $1,500, and there can be additional expenses, of course, associated with changes that you're planning to make. But this is probably one of the best things that you can do. If you're looking to purchase a home, especially if you're buying in the Lower Mainland, the Okanagan, Alberta, wherever you're buying in Ontario, these different types of situations, these houses can cost you a lot of money. And the idea of a $1,500 agreement being expensive is really should not be the case. You should absolutely be investing into something like this, especially if you're looking to buy with a friend or a family member. Now, I'd love to hear some feedback. If you're somebody who is buying with a family member or a friend, is this something that you've done before? Would you do anything differently? Would you add anything to this list? Let me know in the comments below.